In the previous class, we were discussing what is a security, what is a portfolio, and the different stages of portfolio management. Today, we'll look into detail what is investment, because the first topic in your syllabus is sources of investment information. In the previous question papers, there were questions about what is an investment and what are the different avenues of investment was asked as an essay question. The difference between investment and speculation was also asked many times. So now we'll look into what is an investment. An investment is an activity that is engaged in by people who have savings. So what are savings? Saving is that part of your income which you put aside for future consumption. When you get income, you will spend some of it for immediate consumption and you will put aside some part of your income for future consumption. That part that you set aside for future consumption is known as savings. Investments are made out of these savings. So we can say that investment is an activity that is engaged in by people who have savings. Now, all investors are savers, but we cannot say that all savers are investment. People can set aside that savings as idle funds if they want, but it is advisable that we invest those savings somewhere so that it will earn some extra income for the person who made the saving. So, investment involves employment of funds with the aim of achieving additional income or growth in value. That is, when you're making an investment, your main motive is to earn a reward for the investment that you make, to get some sort of a return in future. That is the main motivation behind investments. So you're expecting a return when you're making an investment. So one of the major elements of investment is expectation of a positive rate of return. Now, it is not necessary that every time we will get a return. There's a chance of a risk also. So there is investment risk, which is the second element of investment. It is the possibility in variation in the actual return. Okay, that is that we will have a certain expectation regarding the return that we'll earn in future. If the actual return that we earned varies from the expected return, then that is called investment risk. The possibility of variation of your actual return from your expected return is known as investment risk. So the term investment simply means commitment of funds made in the expectation of some positive rate of return. There are two elements. There's an expectation of a return or a reward, and there is risk involved, which is known as investment risk, which is nothing but the possibility of variation of your actual return from your expected return. Now, investment can be explained in different sense. First one is in the financial sense. That is, you can make a financial investment. If you're making an investment with the intention of deriving a future income, that is, the future income that you receive will be in the form of financial assets like interest or dividend or premium, pension benefit, or appreciation in value of your capital. If you're getting your future income out of investment in the form of financial assets, then that investment will be considered as a financial investment. So investments that generate financial assets are termed as financial investment. You will get interest if you are investing in debentures. You will get dividend if you are investing in shares. You will again get interest if you are depositing in the bank. You will get premium if you are an insurance company and you are giving out policies. You will get pension benefits if you are investing in some pension scheme. And you will get appreciation in the value of capital if you're holding the investment for a long period of time. So if your investment is generating a financial asset, then it is a financial investment. Now, investment can also be explained in the economic sense. When can I say that you're making an economic investment? When you're making net additions to the economy's capital stock, it is said to be an economic investment. What is a capital stock? Goods and services which are used for the production of other goods and services is termed as capital stock. So when you're contributing to the capital stock, you're said to make an economic investment. That is, these investments will generate physical assets. What are physical assets? Assets such as a new building or a plant and machinery, inventory, equipment. When you're investing in these assets, these assets will be used for further production of goods and services. That is, if you are going to produce a particular product, you need land, you need a building there, you need the required plant and machinery and equipments, you need inventories in the form of raw materials or finished goods. So when you're investing in such type of physical assets, then it is considered as an economic investment. You're contributing to the economy's capital stock. Now there's also business investment. These are investments that you make to start your own business venture. In the above two cases, you were giving the money that you saved to people who are running business. But in the first case, in the third case, you're starting your own business. And then you again spend for the modernization, diversification, expansion of the business. All that money that you contribute will be considered as a business investment. Now it is commonly seen that all investments result in the acquisition of some asset, either financial or physical asset. It is also seen that most of the time the investments made in financial assets will slowly get converted into a physical asset. That is, the money invested in financial investments are ultimately converted into physical assets. Suppose you are purchasing the share of a company with the expectation of earning a financial asset in the form of interest. The money that is collected from you for giving you a share, that money will be used by the company for production process. So the money that was collected from you is being converted into physical asset. So financial assets will eventually get converted into a physical asset. This is with regard to the meaning of investment. Now, what are the characteristics of investment? There are certain features for every investment. The first one is return. We said two main elements of investment is expectation of return and risk. So it will also become the characteristics of investment. Return. Return from an investment can be in the form of yield or capital appreciation or both. Yield means the return that you get from the securities in the form of interest or dividend, that is known as the yield. What is capital appreciation? Capital appreciation is the difference between the purchase price and the sales price. When you purchase a particular asset for rupees 10,000 and if you're able to sell it for rupees 13,000, then that 3,000 is your capital appreciation. There is a difference between the purchase price and the sales price. And if your sales price is higher than your purchase price, then your investment has earned you a capital appreciation. And you will also get returns in the form of interest, dividends at regular period of time, depending upon your nature of investment. If you're investing in a highly risky securities, then stable returns cannot be expected, but there is chance for higher returns. Now, the second characteristic of investment is every investment carries a risk. Risk can be in different ways. It could be the loss of the capital, the amount that you invested could be lost forever, or the amount that you invested was not returned as promised on the promised date, or the interest payments was delayed or it was not paid because the company was not earning sufficient profits, or there is variability of returns. The return that you expected was not received. There was a variation between the actual return that you earned and the expected return. So risk can be in different ways. And every every investment will carry a certain percentage of risk. Now, certain factors need to be considered. It is seen that longer the maturity period of your investment, the larger will be the risk. If you are holding investment for 20 years, you're facing more risk than holding it for 1 year, because there's always a chance of decrease in the purchasing power of your money, or the value of your money could erode. So if you're holding it for a long period of time, you're facing higher risk. Now, you should always take into consideration the credit worthiness of the person who is borrowing the funds. You're lending your savings for business purposes, right? So the person who is borrowing it should be a credit worthy person. If the credit worthiness is less, then you're facing a higher risk. That is, if you're investing in a fairly new company, then they do not have a history of performance which you can rely on. Then you're making a higher risk investment, because we don't know, maybe they will not be performing in a good way, maybe they will be performing in a very excellent manner. So if the lower the creditworthiness of the borrower, higher is the risk. Third one is the nature of investment. The risk will vary depending upon the nature of investment. If you're investing in ownership securities like equity shares, you're going to face high rate of risk. But you're investing in debt instruments like debentures and bonds, then the risk that you face will be comparatively less. And if you're investing in government securities, you're not going to face any sort of a risk. There is zero risk involved in government securities. So that is the second characteristic of investment. There will always be risk involved. Third one is safety. We need an assurance that the amount that we invested will be returned at the promised time without any loss of money. Fourth characteristic is liquidity. The money that you invested should be it should be marketable. That is, the security, if your money is stuck in some securities and you're in urgent need of funds, then there should always be an option for you to sell these securities and get back the cash that you invested. So every investor will look into the fact whether the investment has got liquidity, whether it is easily saleable and marketable without loss of money or time. Suppose you are going through a difficult time, you want cash immediately, you're trying to sell it in the market, but you're not able to sell it at present. You might be able to sell it at a future date, but then that is of no use to you. You need the funds now. So yeah, there should not be any loss of time or loss of money. You should always have a ready market available for the securities that you invested in. There is a characteristics, four main characteristics of investment: return, risk, safety, and liquidity. What are the objectives of investment? Best objective is maximization of return. You need to earn as much as you can in the form of dividend, interest, or capital appreciation, yield or capital appreciation. The returns could be in other forms also. These are just few examples that I've given. Dividend, interest, capital appreciation. Now, capital appreciation, I said, is the difference between the the purchase price and the selling price. The capital appreciation could also be in a different way. Suppose you are purchasing 1,000 shares of a company. After a few years, the company is performing really well, so they decide to give some bonus shares to their shareholders. So now you're holding 1,200 shares. You got 200 shares as bonus. There also a capital appreciation is taking place. Now, the second objective of investment is to minimize risk. You're always trying to minimize the level of risk. Now, the level of risk will depend upon the type of the investor. If you are a person who is risk averse, that is, you do not like to take risk, you want stable returns, you want to remain safe, then you will go for that type of investment. You will be investing in more secure investments like debentures and bonds. But if you have an affinity towards risk, you are a risk lover, you want to take risk with the expectation of getting higher returns, then you are going to choose ownership securities or highly risky securities like equity shares. Now, the level of risk will be dependent upon your level of income. If you're a person with a high level of income, then you'll be willing to bear high risk. A person with a low income will not be so willing to take risk. They will opt for stable returns. Now, the third objective of investment is hedge against inflation. There's always the risk of loss in the money value, right? So, if your inflation rate is 10%, the return that you get from your savings should be more than 10%. Then only we can say that you're getting a positive rate of return, or that your real rate of return is to be for your real rate of return to be positive, your return should be higher than the inflation rate. So it's a hedge against inflation. If you keep that money in your hand, then your money value is going to get eroded over a period of time. If you invest in something, you will get an interest rate which will be higher than the inflation rate, and you're earning something. So it's a hedge against inflation. So there are three objectives: maximization of return, minimization of risk, and hedge against inflation. Now, a commonly asked question is, what is the difference between investment and speculation? On the basis of risk, investment involves less risk and speculation involves a higher risk when compared to investment. That is, investment means it is a carefully planned, well analyzed, well planned activity that you enter into, and with the expectation of earning a stable return on capital appreciation. Usually it is made for a long period of time, and the risk involved is less because you have conducted a proper study before investing your money. So an investment is, or an investor is interested in a good rate of return earned on a rather consistent basis for a relatively longer period of time. He will be evaluating the worth of a security before investing in it. But in case of a speculator, he seeks high returns within a short period of time. He is planning to buy at a low rate and sell at a high rate. He is taking advantage of price changes. So he's bearing a higher risk. It might move according to his expectation, or the price might not move according to his expectation. So there's a chance for high loss as well. And these are made for a short period of time. They do not intend to keep the investment in the securities. They are planning to buy the securities at a lesser price and sell it off at a higher price as soon as possible. So they do not intend to hold it for a long period of time. So the risk involved in speculation is high. They aim to earn profit from price changes, and it is for a short period of time. That is the main difference between investment and speculation. Now, what is the difference between investment and gambling? Investment involves low risk, like I said. Depending upon the nature of investment, keep that in mind always. Your aim is for stable returns and capital appreciation. You're investing, usually an investor invests for a long period of time, and before he makes an investment, he will carry out a proper investigation and analysis and plan it out properly. But in case of speculation, it is quite impulsive activity. It is done for a excitement or for a thrill and to get a high return without much sweat. So it involves very high risk in the Sorry, the heading is incorrect. It is gambling. Please make that correction. It is gambling. So it involves very high risk. The profit is, they are expecting to earn the profit by capital appreciation. That is, if you are investing in a race or lottery or card games, then you're depending upon luck to get you some return. So it is purely based on luck, and it is unscientific and unplanned. This is the difference between investment and gambling. Please note that the third column is gambling, and sorry I made that mistake in the PPT. Now, the next topic is what is important to you. The first module is with regard to the sources of investment. So I want you all to find out the different sources of investment avenues or modes of investment avenues. Investment can be made in fixed income bearing securities like government bonds or corporate debentures or corporate bonds, saving certificates or saving bank account. These are all going to earn you a fixed rate of interest. So investments can be made in fixed income bearing securities. Second one is variable income bearing securities. If you're investing in equity shares or preference shares, the return that you get will be based on the performance of the company. They're earning high profits, then good, you'll be getting a good return. If not, you will not be getting returns. So in that case, the returns will not be stable, it will be fluctuating. So variable income bearing securities is your second avenue of investment. Or you do not want to invest in the securities of a company. You want to invest in non-security investments. You want to invest in real estates, or you want to invest in business ventures, art, antique, or something else. Um, Gold, silver are also options for investment. Now you could also make indirect investments. Indirect investment means you're not the one who's opting to invest in a particular company. You're giving it to an intermediary. That is, when you're contributing to pension fund or provident fund, or you're purchasing an insurance policy, or you're handing over your money to investment companies, then they will be giving you a return, but these people will be the ones who decide the portfolio for investment. So you're making indirect investment through the intermediary. You're investing in a particular portfolio of securities. You're not the one who's deciding the portfolio. You'll be just contributing towards the pension fund or provident fund or insurance, and you'll be getting a return. There are different avenues of investment. I want you to go through it in detail. Okay. So in next class, we'll be discussing about the different avenues of investment. Thank you. If there are any doubts, please leave it in the comment box.